Hello everybody and welcome to Risk Awareness Week 2020. The topic of today is the catastrophe insurance puzzle, why people insure their cell phone but not their home. And I'm very happy to be your speaker today. My name is Annette Hofmann and I hold the Robert F. Caroon Chair in Risk here in New York at the Maurice R. Greenberg School of Risk Management with St. John's University. I'm also the director of the Risk Management and Risk Analytics program here at St. John's University. So if you have any questions during this session at any time, please don't hesitate to reach out to me. You can also ask questions in the comments function and I will get back to you. Or if we run out of time, I will answer via email and then we can have a personal chat at a later time. Okay, so let's jump right in. As you can see here, over the last 50 years, the number of catastrophic events has been rising. So you can see here a rising trend for natural catastrophes in dark blue, and man-made disasters are depicted in light blue. You see that there is a decreasing trend over the last 15 years, but overall the average trend is still increasing at a lower rate, but it's still increasing. Now, comparing this with the risks that are insured, you can see here now, in this graph, that the proportion of insured losses is low, and it remains low over time, although, as you can see here, the uninsured losses go up quite significantly. Now, the 10-year moving average of insured losses is indicated in yellow, and it has only a very slightly increasing trend here, whereas the overall average losses go up with a stronger trend. Now, our question today is to find out why we observe this discrepancy and what are the potential reasons for the missing demand for catastrophe insurance. Looking into the literature reveals that the low insurance demand basically contradicts the theoretical optimal state. So in other words, we know that the missing demand for catastrophe insurance implies inefficient outcomes in the economy. And this is because the more risks we take for our business, the higher will be our equity that is needed as a safety buffer to make sure we can survive a large loss. Now, if we don't insure and pool risks, businesses will take less risk. And this leads to possible reductions in investments, employment, and economic growth. Now, economic theory suggests that it is optimal to insure low probability, high loss events. The premium is low relatively spoken, and so even under liquidity constraints, this would be true. But real-life observations reveal that the theoretical findings are contradicted. So we do have a missing demand for catastrophe insurance. A very prominent study by Kuhnreuther and Slovich shows that people are reluctant to insure low probability events. So people look at catastrophe insurance as some kind of investment. And they want to get something out of their investment, right? So they want to see a return on investment. So they have a higher demand for high probability events than for low probability events. They do not get anything out of their policy in most cases when the loss occurrence probability is very, very low. So losses occur rarely. And so the people have the feeling that they just don't get anything out of their insurance policies. We will now evaluate the different possible reasons for the missing demand for catastrophe insurance. And the first reason, now comparing catastrophe insurance to other lines of insurance, it can be stated that the transaction costs in catastrophe insurance markets are relatively high. Now, this is because catastrophic losses are highly interdependent. So when there is a major disaster, big waves of claims are expected, which raises an insurer's auditing costs quite a bit in comparison to other lines. These auditing costs account for a big share of the premiums, and it may be difficult to handle big waves of claims that come in all at the same time. Now, when insurers react to this by randomizing their audits, Policyholders may exaggerate claims more often, and this will lead to unjustified enrichments and more than appropriate indemnity payments. Now, the average expense ratio in the US property and casualty insurance market is roughly 27%. When you compare that to natural disasters that affect not only but to a high scale homeowners insurance and then also flood insurance, earthquake insurance, for these insurance lines we have a slightly higher expense ratio. So for homeowners, for instance, this is 29%. Now, research shows that catastrophe insurance demand is highly sensitive to the price. And the premiums for disaster insurance are often perceived to be inappropriately high. And this comes back to the original idea that I presented before, that people think of catastrophe insurance as some kind of investment, and they don't see any return because they just don't see any losses that are indemnified very often. Now, possible solutions to the high transaction costs are high deductibles, which would reduce the claim wave significantly and also contribute to making premiums more affordable for the policyholders. And another driver to reduce costs can be lower transaction costs due to digitalization, so that claims can be handled more easily and efficiently automatically using technology and algorithms. Okay, so the second possible reason for the missing demand for catastrophe insurance products that we hear about often is asymmetric information and market failure. When it comes to how likely it is that a household will be exposed to catastrophic risk, there's a lot of variation. So some areas are just more prone to disasters than others, and so insurance companies usually assess individual risks by recurring to two sources. First, they collect individual information through the underwriting process. And second, they use databases from external providers or other external sources. Now, the data collection process can be quite time-consuming for the insurance company. It may be associated with administrative efforts for both policyholder and insurer, right? So some customers may even be deterred by this process because it takes so long, and others do not like to reveal personal risk-related information at all. Now, interestingly, there are two direct auto insurers which are both owned by the same insurance group, Allianz Insurance Group in Germany. And these direct insurers collect policyholder data very, very differently. So, for instance, Phoenix Director, which is a Spanish auto insurer, asks for 25 data points, which can be very annoying for the policyholder. And it can also be very time-consuming for the customer experience, right? So to have an adequate pricing, they use 25 data points. Now, in contrast, Genial Light, which is an Italian-based direct auto insurer, asks for only 2 data points in addition to using information from public databases. And they pretty much achieve the same goal doing this. So when the insurers cannot observe all of the risk-related characteristics of their policyholders, they would need to assume an average price. Now, on the picture on the left, you can see 2 lines. The red line is the average price, and the blue curve is the risk-appropriate price. Now, assume that the insurer uses an average price as the premium for the policy. Now, what would happen here if there is an average price? Well, what would happen is that there's different types of risk in the population. So assuming that there's high-risk types and low-risk types, what will happen if the high-risk types in the population are the ones that consider this average price? Now, the high-risk price would think that the average price is a pretty good price, and they would buy the insurance policy. Sorry for that. The low-risk types would think that the price is a little bit too high because they're low risk, and they would abstain from demanding insurance. Now, this creates a pushing effect because low risks are leaving the market, so that the blue curve is actually pushed upwards right? So that at the end of the process, only high-risk individuals would buy insurance at a high price, and the low risks would be pushed out of the market. So the insurers would need to use all relevant information in order to assess the risk. Otherwise, we would see this process, which is called adverse selection. Now, what happens if the high-risk types in the population are the poor? Or how can we make sure that we do not exclude high-risk people from getting health insurance, for instance? How can we make sure that there is no market failure due to this asymmetric information and due to the fact that we have different risk types in the population? There are two solutions. First, this would be the non-discrimination solution if we're using non-discrimination regulations along with compulsory insurance, like the NatCat system in France. NatCat stands for Catastrophe Naturelle. So in addition to the insured citizens and firms, there are three chief actors in the French system. There is the French government, the Treasury to be more precise, and then there is the private insurers and the public reinsurer, which is the Caisse Centrale de Réassurance, which is a French state-owned reinsurance company. Now, second, we can also use taxes. Now, taxes can be used to reallocate wealth between low and high risk types in the population, which is a simple risk pooling transfer, but not a system where we exclude anybody here. There's also heterogeneity in risk prevention across the insured population. So individuals with better coverage are less likely to invest heavily in risk prevention, only due to the fact that they are insured, right? So for example, an individual with the hurricane insurance does not take any protective measures, as damages to his house would be covered by the insurance. So there's the moral hazard effect that comes into play here. Now, insurance companies increase the premiums if they cannot observe this risk prevention behavior due to this inverse relationship between risk prevention and insurance coverage, which means that the premium for the hurricane insurance coverage would go up. Now, due to the higher premiums, the demand for hurricane insurance would go down. As we said, the demand is very price sensitive, right? So the individual terminates the insurance policy because they think that the policy's price is too high. Usually there are two measures that can be taken when we want to resolve moral hazard in risk prevention. So first, policy recommendations to prevent ex ante moral hazard, which are rules for shipping, chemical products, automotive driving norms as speed limits or safety belts, alcohol-free driving, etc. These are mostly organized by regulatory authorities and not by insurance companies. For instance, convincing opinion leaders to follow the rules and thereby trigger the risk prevention for the whole population. Also, price discrimination based on investment in risk prevention measures. If not conducted as in France, people might build their house in areas that are flooded on a regular basis. So it's important to make sure that we can prevent moral hazard, and we can use these measures to do so. Now, a third reason for the catastrophe insurance puzzle are issues with limited liability. So the argument here is that the environmental risks are borne by third parties, so that firms and individuals can generate risks, which are, however, then not borne by themselves, but by third parties. And then in case of a loss, the originator of the risk usually needs to indemnify these third parties in case of a damage. But if we have limited liability, the originator can only indemnify others to the maximum of the given financial resources that he has, right? And this creates a limited liability problem. The limited liability situation is usually exploited by firms so that their risk attitude is more than what would be appropriate under no externalities. So limited liability makes the originator to take additional risk because he does not bear the losses in case of a damage. Okay, so he benefits from taking more risk, and so it makes sense for him to take on a risk-prone attitude, even though he is intrinsically considered risk-averse. Now, therefore, risk aversion is only 100% relevant when firms and individuals are properly capitalized. So as an illustration, look at the two lotteries here on the right. So in the above situation, you own $100 and your expected value from the lottery above is 85, right? 110 minus 25. And then you would probably go for it, right? Because this is a good expectation. Now, in the below situation, you only own $100, so let's assume that this is what you have. And then you look at the lottery below and your expected value is 0. Well, but is it really? Well, you can only lose what you have, right? So this would transfer your lottery to an expected value of 100 minus 50, which equals 50, because you only can lose $100 and not $200. So you have a higher than otherwise incentive to participate in this lottery below. To solve the limited liability problem, either compulsory insurance can be used to ensure that victims are properly indemnified, or a so-called deep pocket solution involving a bank that jumps in when a firm cannot pay for its liabilities. Now, the next reason for the catastrophe insurance market puzzle is a lack of predictability and certain behavioral biases that we're all exposed to as humans. A common bias that is important here can be identified when we look at the following situation. Imagine that you can choose between two urns, two lotteries, and in both cases you would win $100 when you draw a red ball from the respective urn. Each urn includes 100 balls. The urn on the left, urn A, contains 50 black balls and 50 red balls. The urn on the right, urn B, also contains 100 balls, but we have no information about how many balls are black and how many balls are red. Now the question is, which lottery would you rather take part in? Would you take part in urn A, or would you choose from urn B? Which urn would you use? Where would you draw your ball from, urn A or urn B? I give you a second to think about it. Okay, so most people overwhelmingly choose urn A. So people have a very strong preference to draw a ball from the urn where we know exactly that there are 50 black balls and 50 red balls. People have thus a preference for the known rather the unknown situation here. And the guy who invented this experiment is called Daniel Ellsberg, and he was an American economist, activist, and former US military analyst. And he was interested in human behavior and decision-making under conditions of risk and uncertainty. Now, to tell you the truth, the fact is that the probability of drawing a red marble from either urn is identical. So it doesn't matter which urn you choose in order to win the $100. Well, if you are like most people, you will strongly prefer to draw a ball from urn A. And this makes perfect sense, right? Because it seems that urn A is the better choice given the known probability of drawing a red ball, which you know is 50%. Now, however, being now perfectly rational in the face of these two lotteries, think about your preference again. If you really prefer to draw a red ball from urn A rather than B, then your subjective probability of drawing a red ball from urn B must be less than 50%. Since probabilities always add up to 1, this implies that your subjective probability of drawing a ball from urn B must be greater than 50%, and you should therefore prefer to drawing a red ball from urn A, which carries a probability of winning of 50%. Well, and that doesn't add up. So put differently, we can also simplify the problem to evaluating urns containing only 2 balls, and that makes it very easy. Now let's assume that each urn only has 2 balls, right? And we know that urn A then only contains a red and a black ball, respectively, right? And we have, again, a 50% chance of drawing either one. And then urn B has also 2 balls in it, but we do not know of which color these two balls in urn B are. Okay, so obviously the probability of drawing a red ball from urn A is 50%. Now for urn B, we know that there is a 1/3 chance that there are two black balls. There's a 1/3 chance that there are two red balls. And then there's a 1/3 chance that there is one red ball and one black ball in it, right? These are all the possibilities that we have. Now adding these up, the overall chance of drawing a red ball from urn B is thus equal to 1/3 plus 1/3 times 1/2, which is 3/6, which is 50%. So now you can see that it makes no difference which urn you draw from, because the probability of winning the $100 is exactly the same. Now, this phenomenon is called ambiguity aversion, and it is a preference for known risks over unknown risks. An ambiguity-averse individual would rather choose an alternative where the probability distribution is known over an alternative where the probabilities are not known. And it might be that it doesn't matter, but we as humans are just wired that way. Okay, so the next bias that we as humans are often exposed to, unfortunately, is called the status quo bias. And this bias refers to our tendency to stick with where we are right now and don't change the status quo, because we don't know what we're expecting when we change our status quo, right? So now, if asked whether they would be interested in disaster insurance, many people just tend to have a preference for the current state of affairs, which is doing nothing. Now, the individual would rather stay with no insurance than asking for insurance for an event that is rare and whose probability is just not clear, and we don't know anything about it. So finally, people often have problems with guessing probabilities of events that happen very rarely. So this is called the salience bias. It describes our tendency to focus on information that we have that is more readily available to us. And so this information seems more noteworthy. This can also explain, interestingly, the growing market for cell phone policies, because when we look at that, we can see that it's quite interesting how it looks like. So this is a screenshot that I found on the internet, which shows the recent trends in the global cell phone insurance market, but also makes a prediction. And you can see here that, according to this recent report, the global cell phone insurance market was valued at almost $23 billion in 2018. And this market is expected to grow and reach a value of up to $38 billion in 2024. So the cell phone market is growing quite significantly. And this is something that we are more aware of, right? Because as catastrophes don't happen very often, we don't see any return on investment on our insurance products. But with a cell phone policy, and cell phones break very, very often and have other problems, we see a return on investment. And even though it's an object that should not really worry us that much because it's not going to change our life if our cell phone gets broken, people really have a very high demand for these policies. So finally, there are some dynamic aspects that are also important to know about, and which might explain why the demand for catastrophe insurance is as low as it is. We know that there is stereo correlation through time for many catastrophe risks, and insurers use historical data, if available and allowed, to price the risk. So for risk pooling purposes, it might make sense to categorize the risk into several danger zones, like here on the right-hand side in the map for earthquake risk. Now, the zones then can be used to price the risk more appropriately. Now, in the extreme case where the realized risk is fully determined by the current state, and we really know about the risks because we know about all the data, then this would theoretically be not insurable. Now, international risk sharing becomes more difficult when we know more and more about the risks, right? Because as we gain more information about the risks will be priced more accurately. Now, this is called the Hirschleifer effect. So once we know more about the risks, the risk pooling becomes more difficult because we know about all these different influences and characteristics. And then these agreements could only be made before having the specified knowledge. So it becomes important at some point to not know everything about the risk. And therefore, it is important that we have long-term relationships between insurance companies and reinsurance companies to serve society and make these risks insurable in the long term. So diversification through time becomes important. Risk can be diversified through time via credit markets or other financial markets by saving money and taking credits. So in order to use these reserves in case of catastrophe, a loan would need to be established, and then the consumption of the loan would look like this scenario here in light green, where we have a catastrophe that occurs, and then over time, through savings and borrowings, this catastrophe is financed. This is suitable when we assume that there is an infinite life and that the risks are independent through time. Now it's not suitable when we assume that there is a finite life, and then we also see borrowing and liquidity constraints on the markets, which is, of course, sometimes the case for catastrophe risk. Subsidies through government loans could prevent liquidity issues and might be a good tool to help diversification over time. Okay, that's it. Thank you so much for listening, and let me know if you have any questions. You can also email me anytime and I will be happy to keep in touch. You can also get linked to me via LinkedIn. And then, once again, let me know if you have any questions, and I wish you a wonderful rest of Risk Awareness Week 2020.